Welcome to another custom-tailored deep dive. Today's Friday, March 6th, 2026, and if you've looked at a screen or checked your phone today, you already know.
Yeah, it's impossible to miss.
Right. The markets are currently navigating a massive, headline-dominating geopolitical shock. So, the mission for today's deep dive is to get you behind the scenes of what is actually happening on the trading floor right now.
Well, the rest of the world is basically panicking.
Exactly. We're pulling our insights directly from a highly detailed intelligence briefing. It's titled Market Situation Report, War, Gaps, and the Algorithms Playbook. And it was put together by Fennec and Miad Khosravi.
It's a really thorough breakdown.
It really is. Our goal today is to decode exactly how institutional market algorithms are currently exploiting human emotion. And, well, more importantly, how you can avoid becoming someone else's exit liquidity.
Which is what happens to a lot of people on days like today.
Right. But before we jump into the mechanics of all this, it's crucial to state that the sources we are analyzing today touch on highly sensitive, politically charged global conflicts.
Definitely.
We are not here to take any sides, endorse any viewpoints, or make any political statements whatsoever. Our only objective is to impartially unpack the technical and financial analysis contained in this report so you can clearly understand the data being presented.
That is an important foundation to set, because to truly understand the financial ideas in this briefing, we first need to take a completely neutral, objective look at the raw facts triggering today's market conditions.
What exactly are we looking at?
According to the report, there are confirmed accounts of direct military engagement involving the U.S., Israel, and Iran. From a strictly economic standpoint, the immediate result of this engagement is the closure of the Strait of Hormuz.
Which is massive.
Huge. In global supply chain terms, this is arguably the single most critical choke point for global energy. And the reverberations of this closure across every asset class have been absolutely instantaneous.
Okay, let's unpack this, because the immediate market chaos mentioned in the report is intense.
Yeah, the numbers are wild.
The authors point out that oil is gapping up 10 to 12% right at the open. Major stock indices are bleeding out, Bitcoin is dropping, and there is just extreme volatility echoing across the entire board.
It really looks like a financial battlefield. Everything is flashing red.
It does. But Fennec and Miad make a fascinating argument in their briefing. They say that what is happening underneath the surface is not chaos at all.
Not at all.
It is actually highly organized.
It is incredibly organized. And to understand why, you kind of have to look at the core disconnect between human emotion and algorithmic logic.
Right.
When bombs drop, it is a deeply human reaction to panic. The natural instinct for a retail investor is to sell, to move to cash, to protect their capital from what they perceive as total global chaos.
Which makes sense emotionally.
It does, but institutional algorithms do not watch the news, and they certainly do not feel fear. They are programmed to ask a very different, very cold mathematical question.
Which is?
Does this specific geopolitical event actually impact the revenue streams of the megacap companies that make up the index? Right, like, does a closed energy strait in the Middle East fundamentally stop consumers from buying iPhones from Apple, cloud software from Microsoft, or AI chips from NVIDIA over the next 5 years?
And the algorithmic answer is no.
Exactly. The answer is no.
And what's cool is the report mentions they didn't just guess at this theory. They actually used AI to validate historical data.
Yes.
Did they find any solid precedent for this kind of market behavior during past wars?
They did, and the results they uncovered are honestly staggering. The authors detail how they fed 50 years of daily S&P 500 data into Claude and Gemini AI terminals.
50 years?
Yeah. They had the AI map out every major military conflict since the Vietnam War in the 1950s. They were specifically measuring the market's 20-day forward return following the initial shock.
So they just let the AI crunch the numbers.
Right, because the AI was able to traverse that massive data set and calculate the returns with a level of precision that would take a human analyst weeks to do manually.
And what did the AI actually find?
Out of 6 major global conflicts over the last half-century, 5 of them produced positive 20-day returns for the market.
That's crazy.
Think about that. The initial terrifying dip was aggressively bought almost every single time.
The specific historical examples they pull out of that data set are wild, too. They note that during the Gulf War, the market produced an 11% rally within just 20 days of the conflict starting.
Yeah, 11% in 3 weeks.
And look at a more recent example, the Russia-Ukraine invasion. The briefing highlights that on the very first New York trading session after the invasion began, the NASDAQ had a massive, record-breaking 950-point swing.
Which is huge.
Right. That is roughly a 7% move in a single session, which was then followed by a 10% rally from the lows over the next 10 to 20 days.
It's fascinating here is that buying the dip during a war is not just some Wall Street folklore or a vague sentiment that traders talk about on social media.
It's in the code.
Exactly. It is a hard-coded statistical reality inside institutional algorithms. They know the long-term revenue of these tech giants isn't fundamentally damaged by these specific regional conflicts.
Right.
The algorithms simply recognize the fear-driven sell-off as an inefficiency, a temporary mispricing of actual corporate value, and they mechanically step in to buy the panic.
Which brings us to the most obvious headline right now, the one everyone is talking about.
Oil.
Oil. With the Strait of Hormuz closed, the report notes that oil prices are spiking into the $75 to $77 range.
Yep.
And if the conflict premium is sustained, they're looking at implied spikes all the way up to the $80 to $90 range.
That's the projection.
So if everyone knows the strait is closed, and that is terrible for global supply, why wouldn't oil just keep going up indefinitely? Like, why isn't this a sure thing buy for you right now?
Because that assumption is exactly where the trap is set for the average trader. The report explicitly warns you about what they call the hot potato effect.
A hot potato effect?
Right. Everyone, including the massive institutional funds, anticipated that a closure of the strait would cause oil to spike. The premium for that event is already baked into the price by the smart money.
Ah, so they were already in.
Exactly. Now that the catalyst is finally here and making terrifying headlines on every news network, late, uninformed retail traders are rushing in to buy out of FOMO, fear of missing out.
And the smart money.
Meanwhile, the institutional investors who position themselves weeks or months before the event are using that massive influx of late buyers as the exact liquidity they need to exit their own long positions.
It's basically a high-stakes game of musical chairs. The retail traders are rushing in because they hear the music playing on the news, but the algorithms own the stereo, and the second retail sits down with their new long positions, the algorithms pull the plug and cash out.
That is a perfect way to look at it. They need you to buy so they can sell.
Here's where it gets really interesting. The mechanics of what the report calls monthly gaps.
Right, the gaps.
Because the oil futures gapped up so aggressively at the open, there is essentially a blank space on the chart. For anyone who hasn't stared at a trading chart all day, a gap is literally just an empty space where the price jumps so fast overnight that no trading actually happened at those middle prices.
Just a total blank zone.
And the report points out that algorithms are structurally programmed to pull the price back down to fill that blank space once the initial conflict premium fades. They do not leave those gaps open indefinitely.
Exactly. The major takeaway for you here is do not be left holding the bag when the music stops. Buying oil after a massive gap up is exactly what the smart money wants you to do.
Right.
Oil is serving as a bellwether for global risk appetite right now. It is not a safe, long-term directional trade.
So we can see how they trap retail traders in the oil market. But how does this translate to the broader stock market?
It gets even more specific there.
Yeah, the briefing outlines a generational setup for the S&P 500 and the NASDAQ, and it reads like a highly specific battle plan. For the S&P 500, they point out that the futures gapped down, targeting what they call an inside 2-week candle failure. What does that actually mean in plain English?
Without getting bogged down in the textbook definitions of candlestick charting, an inside 2-week candle failure essentially means the market is painting a picture that looks like a devastating breakdown.
So it looks terrible.
Right. It is designed to look like the floor is falling out, which triggers retail traders to panic sell their positions or open short trades, betting on the market crashing further.
But it's a trap.
Structurally, it is a fake out. It is a trap waiting to be sprung to raid downside liquidity. They are intentionally pushing the price into a zone where they know everyone's stop losses are sitting.
And the mechanical trigger for this reversal trap is the VIX, the volatility index. The report expects the VIX to spike from its current level around 19 up to 23. Why is 23 the magic number here?
Because 23 is not just an arbitrary psychological level. When the VIX hits 23, it trips a wire.
A wire.
Yeah, Wall Street has massive, multi-billion-dollar volatility control funds. These funds do not trade based on human discretion. They have strict, automated risk mandates.
Okay.
When that volatility wire is tripped at 23, their computer models are literally forced to step into the market and buy call options to rebalance their risk.
They don't have a choice.
It's not a choice, it's math. And that forced buying creates a massive surgical reversal in the market.
That makes so much sense. So the report lays out an exact, non-negotiable sequential playbook for anyone looking to trade this.
Yeah, step by step.
Step 1, wait for the regular cash session to open. Don't trade the overnight futures chop. Step 2, watch the VIX hit that magic tripwire number of 23.
Crucial step.
Step 3, target the SPY gap fill zone, which is sitting between 571 and 574. And here is the optimal vehicle they suggest, purchasing April 17th SPY call options. But they are very specific that you must only do this after the initial market flush compresses the option premiums.
Right, you don't want to overpay for the contracts while volatility is maxed out.
Exactly. Once that sequence plays out, their ultimate upside target for the S&P 500 is 6,973.
And if we look over at the NASDAQ, the structural charts are demanding a remarkably similar move.
Oh, really?
Yeah, the tech index is targeting a specific downside liquidity pool at 23,840. The authors remind you that we literally just saw a rehearsal for this exact scenario.
When was that?
Just last week. The algorithms used NVIDIA's highly anticipated earnings report to trigger a massive raid on downside liquidity before executing a sharp, aggressive reversal.
So they've done this before.
The geopolitical headlines today are just the new excuse. The underlying algorithmic structure requires this liquidity grab to happen regardless of what the news anchor is saying.
It is wild to think about the terrifying headlines just being a narrative excuse for what the chart already demanded. So that's the traditional market that closes with a bell. But what happens in a market that never closes?
Crypto?
Right, where the algorithms don't have to wait for Monday morning. Yeah. Let's pivot to crypto. Because Bitcoin trades 24/7, the report notes it actually had a head start on pricing in the panic before the traditional futures markets even opened.
True.
They point out Bitcoin has been printing lower highs since January 2026, essentially front-running this geopolitical shock.
Yes, the crypto market is often the canary in the coal mine for global liquidity. But there is a very clear line in the sand for Bitcoin right now, and that is $60,000.
60,000.
According to the chart structure, Bitcoin needs to flush down and raid that $60,000 downside liquidity pool before any bullish bias can shift back into gear. It needs to clear out the weak hands.
And then what?
Once it hits that $60 K mark and triggers the reversal, the target zone moves back up to the $70,000 to $71,000 range. They specifically advise watching the IBIT ETF when the traditional cash markets open, as that will provide the true directional confirmation from institutional money.
Got it. Let's shift gears to a traditional safe haven. What about precious metals? The report highlights that gold is sitting at all-time highs. It's got a gap staring at us between 5,140 and 5,420.
Right.
And Finnick and Miad point out this move was heavily telegraphed ahead of time by gold miner stocks, specifically tickers NEM, AEM, and FNV, which were already reaching their own all-time highs before the conflict even escalated.
They were already moving.
So if gold is the ultimate safe haven during a war, why shouldn't someone just buy gold options right now?
Because here's where we have to talk about the cruel math of trading options in a high volatility environment.
The cruel math. I like that.
It is cruel. Gold has its own volatility metric known as the GVZ, and it is currently sitting at 33. That is an extreme, historically high reading.
What does that mean for the average person?
What that means in plain English is that the price of options contracts is incredibly inflated right now because everyone is scrambling for protection.
Right.
At this level of volatility, even if you guess the direction of gold perfectly right, the eventual collapse of that volatility premium, what traders call a vol crush, will likely destroy the value of your options trade.
So you win the direction but lose the money.
Exactly. The market is essentially telling you that the fast, easy money on gold's advance has already been made. If gold gaps up and fills that 5,140 to 5,420 zone, the institutional move is to close their long positions and take profit, not open new ones.
Wow. And the warning they give for silver is even more urgent. They note that silver is currently in what they call a counter-trend Elliott wave rally, targeting the 99.626 to 104.637 level.
Right.
Without getting a PhD in technical analysis, think of the market moving in waves, like taking 3 steps forward and 2 steps back.
Yeah.
Right now, silver looks like it's rallying aggressively, but structurally, it's just taking one of those steps back before resuming its overall downward trend.
It's a trap.
It is a trap. The authors are very clear. This zone is strictly risk-off. It is a place to take your profits and walk away. It is absolutely not a place to buy more. Until silver makes a new all-time high, every rally you see is just a counter-trend illusion designed to pull in retail money.
Moving across the global board, the report also touches on the Forex markets, and the setups there perfectly mirror the contained, calculated energy we're seeing in equities.
How so?
Well, for the US dollar to Japanese yen pair, or USDJPY, there is a massive setup right now. If the risk-off panic pushes the pair down to its daily support level at 155.644, the report identifies that as a highly probable bullish long entry, targeting a bounce up to 157.662.
Okay, so you buy at 155.644.
Right, but here's the trick. It is only when it reaches that higher 157.662 level that their short thesis activates. They are playing the bounds of the trap.
And what about the euro?
Meanwhile, for the euro to US dollar pair, or UNFD, their strategy requires total discipline. The pattern there relies on waiting for Friday's non-farm payroll, or NFP, report to provide the true economic catalyst. Entering a position before that data drops is considered gambling, not trading.
Gambling versus trading. That makes total sense.
If we connect this to the bigger picture, what stands out to you listening to all of this?
Yeah, what's the big takeaway?
Because if you step back from the charts and the specific numbers, the overarching theme of this entire intelligence briefing is somewhat chilling. It shows that in modern markets, emotional, terrifying geopolitical news is actively weaponized by smart money.
Weaponized.
They literally use the genuine panic of the everyday retail trader to create the massive pools of liquidity they need to execute their pre-planned, structurally aligned algorithmic models.
So what does this all mean for you, the listener, navigating this right now? The ultimate lesson Fennick and Miad want you to walk away with today is the power of profound patience.
Patience is everything today.
Let the VIX blow off and hit its tripwires. Let the monthly gaps form on the charts and do their mechanical work. Understand that the cold, hard, algorithmic structure dictates market direction far more than the scary headlines flashing across your television screen.
Exactly.
Let the dust settle, wait for the algorithmic flush to happen, and trade the underlying structure, not the human emotion.
And this raises an important question, something for you to mull over long after we sign off today.
What's that?
We have just established that modern algorithmic trading models are now perfectly optimized to exploit human fear and geopolitical conflict by automatically buying the panic.
Right.
So what happens to the global economy when AI systems become so advanced and so integrated into global infrastructure that they actually begin to subtly trigger these financial panic events themselves just to harvest the predictable liquidity?
Now that is a thought that will keep you up at night.
It really is.
Thank you for joining us for this deep dive into the true mechanics of crisis trading. Remember, understanding the playbook and having the knowledge of how these algorithms actually operate behind the scenes is your absolute best defense against the panic. Keep questioning the narrative, stay incredibly patient out there, and as always, stay curious.